So, in our last episode, Jake Sullivan and I discussed the return of the old normal, the return of a more contested geopolitical map with fragmented alliances, regional spheres of influence, and greater friction, in which the main theater of competition is now in economics. But the contest isn't just being fought with tariffs and industrial policy, it's also happening with capital flows. We're moving back to an era of entrenched imbalances that translate directly into strategic leverage. The way I put it, real power isn't just in the trade flows we see, it's also in the shadow reserves we don't. And to understand what's going on, you've got to get inside the world's financial plumbing. You have to follow the money, especially where it doesn't want to be found. Joining me today is the world's most beloved financial plumber, my longtime friend, Brad Setzer. He's the Whitney Shepardson Senior Fellow at the Council of Foreign Relations. Brad also served as a senior advisor to the U.S. Trade Representative in the Biden era. And in the Obama years, he ran international economic analysis at the White House and the Treasury Department, where we became basketball buddies. So, Brad, good to see you again.
Indeed. And my basketball skills have done nothing but deteriorate since we played together, sadly.
You and me both. We'll have to see if we can get out there again sometime soon. But, look, I want to recapture some of the conversation that we had in Florida for our listeners. But before we do that, I want to humanize you because I'd say you have a rare following for an economist. I'm told well over 120,000 people follow you on Twitter. So explain this for me, please. You grew up in Kansas, as far as a person can get from global financial markets. No offense to Kansas.
Mm-hmm.
And yet you've spent your career decoding the most complex capital flows on the planet. So how'd that happen?
Well, I think people who grow up in what is sometimes, and I don't like the term called flyover country, do develop a curiosity for what's going on in the rest of the world. And I think that was certainly the case for me. Like one of the things I actually liked growing up about Kansas was there was always an agricultural markets report on at noon on the local radio station. So maybe that triggered a bit of interest in financial markets and flows. My dad grew up on a farm, but he himself was a physical chemist. And so I always sort of liked math, and decoding financial flows is just kind of applied math. So to me, it doesn't feel like a huge jump. It feels like a steady evolution. You look for something you like doing, and I found it.
Well, I mean, the world is definitely reaping the benefits of your choice. And by the way, there's a reason we get along so well. I grew up in North Carolina, come from a long line of farmers in northern India. So hey, I understand your path. Okay.
Wheat farmers or cattle farmers or,
I think mostly wheat.
Okay, good.
Not so much the meat. Yeah. But probably some of both. All right, let me before we lose all of our listeners, let me come back to the big picture. So Brad, your thesis is the world isn't actually decoupling in the way that people say. You've said that we're seeing an unhealthy re-globalization. Trade flows are actually up, but they're distorted and dangerous. I agree with you, but can you unpack what you mean?
Sure. I mean, in the simplest way, global trade hasn't actually slowed that much. It didn't slow at all, actually, even with all the tariffs last year. And what's perhaps more striking is that China's export growth continues to be substantially stronger than global trade, even with all the trade frictions. So last year, China's exports in volume terms are going to grow by about 10%, 10%. Global trade was growing at 4 or 5%. The previous year, China's exports grew by over 12% when global trade was growing at 3%. China's overall surplus in trade in goods now reached $1.2 trillion. That's a huge sum. It's a big increase relative to where it was when the Trump tariffs were started, let alone relative to where it was even a couple years ago. So to me, it is hard to describe the world as decoupling or fragmenting, or that globalization is going in reverse when the world's biggest manufacturing exporter is exporting more than ever before. Now, it is true that less of that comes to the U.S. directly. More is going to Europe, and more takes a one-stop flight rather than a non-stop flight. So there's a lot of intermediary hubs in Southeast Asia that import parts from China, assemble them, and send them to the U.S. But in aggregate, global trade is still growing, and in aggregate, trade across geopolitical blocks is still growing, even if in a sort of disguised way. Now, I do view this as unhealthy because to me it reflects an unhealthy reliance on China's part on exports for growth. Ever since the property market bubble burst in 2021, China's domestic drivers of growth have been very, very, very weak, particularly investment, particularly property investment. But consumption growth has also decelerated. So China, in a sense, has had to rely on demand from the rest of the world to make up for its lack of internal demand generating capacity. To me, that's unhealthy. And then the other component that is unhealthy, and this is, one of those little but important facts about the contemporary global economy, is that our biggest bilateral trade imbalance with Europe is now no longer Germany. It's Ireland. Right. And that speaks clearly because American companies avoid paying American tax by producing in Ireland. And to me, that's another form of unhealthy globalization. But it's hard to say that the world has stopped globalizing when companies are still locating production in a way to minimize their tax, and when China is becoming more, not less important to most production.
Let's focus on China's balance of payments. As you point out, Brad, since the tariff war began, China's manufactured goods surplus has boomed to levels the world has never seen before. It's now redirecting its exports from the U.S., where it faces very high tariff rates, to the rest of the world. So the question is, why haven't more countries outside the U.S. also raised tariffs on China to salvage what's left of their own manufacturing sectors, especially in Europe where the political stakes are so high?
No, I mean, I think you do see some targeted barriers. Brazil, for example, put up a barrier on Chinese steel because they said, well, why are we shipping our iron all the way to China just to bring it back in the form of steel? Indonesia has started to put in place some tariffs on clothing imports from China. Again, like, why are we, a relatively poor country, importing cheap clothing from China when this is a traditional Indonesian export sector? India has maybe not added to its barriers to China, but it always has maintained relatively high barriers. But for many countries in Southeast Asia, it's complicated because they have to import from China in order to export to the U.S. And while it is possible to kind of differentiate the two if you work real hard, for most of them, the business of taking Chinese parts and assembling them for sale to the U.S. has been a growth driver. Clearly for Vietnam, it's been a positive, not a negative. For some of the other countries, it's a little bit more balanced. I think Thailand is going to be an interesting case to watch because the traditional Thai automotive sector has been hurt a lot by imports of Chinese electric vehicles without generating that offsetting export edge. Europe is the hard case. And Europe has really been hit pretty hard, arguably harder than the United States, but by what I call and what others call the second China shock, this re-acceleration of Chinese export growth, the rise in China's manufacturing surplus from $1 trillion to $2 trillion, 2% of world GDP, and China's emergence as the world's biggest auto exporter, which is remarkable. 5 years ago, China exported 1 million cars, imported 1 million cars. Annualize the December exports from China. Vehicles, it's 11 million. Passenger cars, just straight up cars, 10 million. So huge swing. And imports have gone from 1 million to 500,000. That has had a big impact on Europe, a big impact on Germany in particular. German exports to China are down by about a percentage point of German GDP. And overall European exports to China have fallen by about a half point of European GDP. So there's sort of just an unambiguous negative shock coming from China on the export side, and imports are pouring into Europe. Now, Europe has made taken a few steps to try to limit this. some rather ineffective tariffs on electric vehicles. But Europe's unambiguously been slow. And I think part of that is that Europe remains wed to the traditional global trade rules. It's reluctant to tear those up and say, look, we just have to do across the board sectoral tariffs. They want to sort of fit everything into a WTO investigation, which takes time. I think part of it is that Germany, and particularly the German auto companies, have been a bit conflicted. VW and BMW at times seem as interested in using China as an export base, as concerned that Chinese automotive companies using China as an export base are cutting into their market share. And they're very focused on the risk of being squeezed out of the Chinese market, not just their export business, the Germany to China business, but the made in China for China. And then
A lot of confusion between what is good for a corporation isn't always good for the country.
exactly.
That's
That's been very, very pronounced. But then the other thing, just to be fair, I mean, to be honest, the U.S. hasn't made it easy. And by that, I mean, when the U.S. puts up tariffs on Europe and more or less says, we want to cut off our trade with you, I think that has made Europe a little bit more reluctant in the short run to just say, oh, look, we've got to focus on China. So I do think there's been a bit of that a potential alliance or area of agreement between the U.S. and Europe has been short-circuited by a U.S. president who's frankly focused in the last 6 months more on Europe than on China.
Well, let's turn before we come back to the U.S. president. Let's turn to the capital side of the ledger. You mentioned the kind of unimaginable surpluses that China's now running. I think 2 trillion plus in terms of manufactured goods, and over 1.2 trillion for the trade surplus overall for the past 12 months. But yet we've not really seen an explosion of China's reported reserves. We haven't seen a real trade-weighted appreciation of the currency. What's going on? What's going on with China's balance sheet?
Yeah, I mean, it's fascinating, to be honest. Two important points there. One is that China clearly made a policy decision, probably made the policy decision 15 years ago and effectively executed and implemented 10 years ago, that 3 trillion and change was enough reserves. So since since there was sort of a volatile period, I'm sure you remember well, we were both at Treasury when China sort of did a botch exit from crawling appreciation, basically
August 2016, right?
August 2016 of 2015.
Oh, yes. Okay.
2015. And it did cause a lot of chaos. I mean, it was a shock. And then there was China had to draw on its reserves and to stabilize flows, and then it sort of kind of stayed stuck at the same level of reserves for the past 10 years. So in some sense, China has decided it doesn't want more formal reserves. And that has meant that money that otherwise would have gone into reserves gets channeled into the policy banks, China Development Bank, Belt and Road Lending, the equity vehicles run by the State Administration of Foreign Exchange, the Silk Road Fund, the China Latin America Industrial Development Corporation, or something like that. Various vehicles that support China going out. And then you see much more activity in the state banks. That is a general factor over the entire decade. And as a result, just as the way we collect capital flow data and holdings data in the U.S., we are much better at collecting data on the formal holdings of China in its formal reserves than at capturing everything the state banks are doing. So in some sense, it's not a mystery or a surprise that the big increase in the surplus hasn't registered in formal reserves. That's been pretty consistent. But the other really important thing is that you can track pressure on the currency by what's happening to the state bank's balance sheet. And in 23, first part of 24, there was actually pressure on the China's currency, the yuan, to depreciate. There was some would fall in the foreign assets of the state banking system. That reflected, the fact that we in the U.S. had higher than desired inflation. The Fed had quite high rates. China was in deflation. Chinese rates had come down a lot. And so there was a period of time when the overall pressure was for a further depreciation. That pressure, the direction of pressure, in my view, clearly changed after China survived the first salvo of the tariffs, after the reciprocal tariffs were introduced. And then there was this massive wave of retaliation. Tariffs went up to above 100, and then they came down, I think, in May or June with the negotiations in Switzerland. During that period, China did not allow the yuan to fall further, which sent us important signal, in my view, that they were confident that they could weather this shock, and they did. And then as their trade surplus continued to grow, you clearly see the state banks start to accumulate foreign assets in a pretty big way. And that picks up even more in the fourth quarter. And then in December, the state banks report a $100 billion increase in their foreign assets.
Let's pause for a moment on what this strategy does for China. There seem to be at least two benefits. First, the accumulation of dollars by state banks suppresses the appreciation of the renminbi and keeps China's export machine humming. And second, it creates a piggy bank of dollars that can be spent and lent for soft power, to finance infrastructure across the world, to buy strategic assets like mines for critical minerals, and to make investments in critical supply chains. Is that fair?
Look, unambiguously, the accumulation of foreign assets, foreign currency has, for the past 6 months, limited appreciation of the Chinese yuan against the dollar and, in a sense, prevented a correction in the depreciation in the yuan that happened in the first part of 2025 when the yuan was tightly pegged to the dollar and the dollar sold off on Liberation Day. So yes, it clearly had the impact of keeping the yuan weaker than it otherwise would be. And the yuan is now down in real terms, inflation-adjusted terms, roughly 15% over the past 3 or 4 years. And I think that explains to some degree why Chinese exports have outperformed. Now, the Chinese would probably say that all these dollars are a bit of a burden as well as a bit of a strategic asset. The strategic asset is clear. I mean, the Chinese policy banks are not constrained if they want to fund any project anywhere in the world. Chinese state banks can lend money to any Chinese state enterprise that wants to expand or do a strategic acquisition anywhere in the world. I think it was interesting that Nexperia, the Dutch semiconductor firm that the Dutch wanted to, kind of force China out of last fall, that had been bought by another Chinese firm, by Wingtech, with money from a Chinese state bank. And I think we need to kind of think a little bit about China as not just buying bonds, but providing a lot of loans for various strategic acquisitions to pursue various strategic goals. The one place where China has had difficulty, I think, translating their financial strength into political leverage is that they've never really found a way of turning their holdings of U.S. Treasury bonds into leverage over the U.S. Treasury. We can discuss why, but I think from the Chinese point of view, they came to the conclusion that they could get more strategic bang for their buck by putting the money through the state banks and doing a range of other things than they got just holding Treasury bonds in a predictable way. And then they also took less political heat for finance in the U.S.
And one symptom of that is the Belt Road Initiative, the scale and the scope of it over the past 12 years.
And indeed. I think it's underappreciated, in part because the Chinese have done a pretty good job of hiding it, how much of the Belt and Road was financed out of money that otherwise would be for classic foreign exchange reserves. There was I'm sure you remember this, but there's an underappreciated, there's a forgotten term, entrusted loans, where the State Administration of Foreign Exchange, China's reserve manager, entrust its foreign exchange with the state banks to just fund whatever they want. That there's not getting much press. That doesn't get as much press, but it hasn't gone away. And then in 2015, when China really wanted to gear up to finance the Belt and Road, 95 billion, close to 100 billion of entrusted loans from SAFE were converted into equity to allow CDB, China Development Bank, and China XM to finance this outward push. So we, like, right there, you have like the classic transaction where money that would otherwise be reserves is directly financing the Belt and Road. Now, I think China has let things evolve a bit. There's less money going into like building dams or building roads, particularly in Africa. More money is going to, in part because China's had trouble getting its money back. I mean, and not because of a lack of financial wherewithal on the Chinese side. And more money is going directly to state firms who then make investments. So there's been some evolution, but yeah, I mean, China's state is in no way financially constrained in pursuing its global ambitions. And China now has the added complication of figuring out what to do with this surge in foreign asset accumulation, which probably exceeds its ability to lend it out.
Yeah, good problem to have. Let's talk
Since you're a fund manager nowadays, of course.
If you have too much money to invest, there are worse problems in the world. So let's connect the dots from China to Mexico. USMCA is out for review this year. The problem of transshipment looms large. You referenced it earlier. Countries that are highly tariffed by the US, like China, are routing their exports to the US through lower tariff countries like Mexico. So from the US perspective, Brad, do you think the objective of the USMCA review is to solve that problem? Or is it to reduce US imports from Mexico, period, wherever the goods are made? Or is it both?
Well, I think the U.S. faces a kind of fundamental choice in the renegotiation of USMCA. Well, it faces two fundamental choices in the renegotiation of USMCA. One is, does it want to have a free trade agreement with both Mexico and Canada? Or does it want separate agreements with Mexico and a separate agreement with Canada? And I think the Trump administration hasn't been clear on that. And then particularly with respect to Mexico, is the U.S. goal to restrict trade between the U.S. and Mexico, which would, imply transforming the USMCA so it's much less of a free trade agreement, making it a much more managed trade, restricted trade arrangement, which, you could argue would be a way of reducing U.S. automotive imports from Mexico. So you can make that argument. It wouldn't be the argument I would make, but you can make that argument. The alternative is to focus on strengthening, in a sense, the bilateral component of trade and making sure that trade between the U.S. and Mexico is really Mexican goods for U.S. goods, not Chinese parts assembled in Mexico that go to the U.S. And if that's your goal, the emphasis would be on harmonizing the external tariff so that goods going into Mexico from China face roughly the same tariff as goods coming from China to the U.S. in which
Possibly subsidies as well, Brad? Harmonize the subsidy regime within North America?
I mean, I would start with harmonizing the tariffs, but yes, I mean, you could think of harmonizing the subsidy regime or opening up various subsidies to content that comes anywhere in North America. I mean, if you really have a fortress North America vision, you would rather have goods be made in North America with a mix of U.S., Mexican, Canadian content than subsidized goods coming in from the rest of the world. And that there's always a little bit of tension between doing that, Fortress North America, and Fortress America. So I do think that is one component. And then the other
Fortress North America could involve, I mean, in the limit, you could think of common external tariffs, a common subsidy regime. Let's just say more generally, a common set of industrial policies, maybe a common set of investment screening and export control provisions. I mean, it could be a really ambitious undertaking, but it seems unlikely that's where this is headed now.
It seems unlikely. I mean, personally, as you know, I think that would be a healthy evolution. And I think some harmonization of the tariff regime is absolutely essential. It just no longer makes sense for the U.S. to have, for the legacy 301 So the Trump 1 tariffs with the Trump 2 tariffs layered on, that'll generally be a 45% tariff right now. But if the components to make that good go to Mexico, until some of the recent adjustments, that might have been tariffed at 0, even if it was 75% Chinese content. That is an incoherent tariff regime. For the Trump 2 tariffs, the tariff on China is only 20. Maybe you would still keep on buying it from China, given the weakness in the exchange rate. But to some degree, if you're going to have really high tariffs on China, you cannot ignore the amount of Chinese content in goods coming through Mexico. Whereas a traditional free trade agreement, you have rules of origin only for certain goods that matter, like autos. But for most goods, U.S. tariffs were 0. So for most goods, the free trade agreement was reducing tariffs from 0 to 0, and you didn't care that Mexico was importing goods from China back then at 0. So you could manage a low tariff world without extensive rules of origin. We're no longer in a low tariff world. So I think we have to do that. And then I think the next question is, do you go?
How do you enforce it? How do you?
No, I mean, the easiest way to enforce it is you have the same tariff, and then you don't have to worry about the rules of origin. So, if your tariff on computer components is 15 and Mexico's is 15, you don't worry if it's 80% Chinese content. They're paying the same tariff.
Then your work is done.
Yeah, you could do a embedded Chinese content test, which would be much more paperwork, much more work. I think we have to think about these things, though, because this is not just an issue with respect to Mexico. It's an issue with respect to Southeast Asia. With Mexico, in a sense, it's probably easier because you could imagine a common tariff. You could imagine a common system of investment screening. You could imagine common subsidies, common a real commitment to common rules for a common market.
Brad, when you were at USTR, I wonder if you gained a perspective on how long it would take us to get to the point at which we could tariff embedded inputs. I'm thinking in particular about lagging edge chips, in which, China's running the same playbook that it's run for several decades and amassing pretty significant global market share. I don't think we've ever tariffed, the US has never tariffed an embedded input that you'd have to find by disassembling a consumer electronics product. Am I wrong? And how long would it take to fix that problem?
You are not wrong. That's true. The only sector where we actually have detailed rules of origin, I mean, the USTR people will say, well, there's some on chemicals and transformation rules about precursors. But the key sector is basically autos. With electronics, the global tariff has long been 0. So there's essentially no meaningful rule of origin, nor is there any capacity to enforce a rule of origin. So how quickly could you change that? I think you would have to do a global tariff with exclusions. And so the default would be a tariff, and then you would exclude all legacy chips that don't come from China and put the burden on the importer to show that the chip doesn't come from China. So that would be an administrative burden. It's paperwork, it's regulation. But I don't see any other way of doing it in a relatively simple way.
Brad, let me go back to Asia and raise a country for which we can draw a sharp contrast with China, which is Japan. It's submitted to market forces and it's feeling the volatility of those market forces. You've made a compelling case that if we look strictly at Japan's external accounts, its massive current account surplus and net foreign asset position, the yen appears grossly undervalued. Yet the market is obsessed with the spot interest rate differential. The BOJ base rate is lower than that of almost all of its trading partners. How do you explain why the market is ignoring Japan's balance of payments? And even as you point out, even with a relatively healthier fiscal backdrop than what we see in the US. Any theories?
I mean, I certainly have some theories. I don't know if they're very good theories. If you want to push the argument even further, the market now is also, to a degree, ignoring interest rate differentials. Says the interest rate differential it's still big, but it's come down. And the yen used to track, say, the 2-year or 5-year interest rate differential pretty closely. And that correlation has actually gotten weaker too. What I think has been happening is that Japanese institutions have made a lot of money by betting against their own currency. And the profits that Japanese institutions have made by betting against their own currency, if you're a Japanese institution, you hold dollars, the dollar goes up, the yen goes down, you book a big profit. And that profit has helped offset losses on the bond book of Japanese institutions. When U.S. rates went up with inflation shock, there was a big mark-to-market loss across Asia on legacy bonds, 10-15% on most bonds held in the insurers and other Japanese institutional investors' books. And then when Japan raised rates and exited from yield curve control, there were further mark-to-market losses on the insurers and others' legacy holdings of Japanese government bonds. And so I think one byproduct of that is that institutions have been structurally a bit slow to adjust their hedge ratio and to pay the reduced but still significant cost of hedging in the expectation that the yen would continue to depreciate. So I think that's one factor.
Yeah.
I think actually some Japanese institutions misunderstand the likely long-run impact of a slight fiscal easing. They think it's going to like erode credibility and lead to out of control yen weakness, to go from a fiscal deficit of maybe 2.5 this year to 3.5, even though that's way smaller than the fiscal deficits of France, the UK, the US. So if you worried about fiscal deficits, you wouldn't go from Japan at 3 to the US at 5.5 going to 6. But a lot of institutional investors seem to be convinced that the fiscal shift will have negative impacts on Japan's long-run capacity to maintain a stable debt to GDP ratio at a very high debt level. Now, traditionally, a fiscal expansion leads to higher interest rates and it supports a currency. That was what happened in the U.S. when the Fed raised rates in 22. That was, the Volcker shock. So I'm not sure that the economics completely fit there, but that's sort of part of the argument. And then the final...
Just taking that point, I mean, isn't this a problem that could easily be fixed? Let's just say the BOJ decides, because of a looser fiscal stance in Japan, they're going to surprise market expectations slightly to the upside and hike 2 or 3 times in the first half of this year. And if they're kind of lucky, the Fed might take a dovish shift in its reaction function after May, and suddenly the interest rate differential picture looks very different, and you still have the favorable external account backdrop. I mean,
that's kind of what I would expect. I mean, that's why I've been a bit surprised by the persistence of this belief that that Japan will run a looser fiscal policy, that inflation will be a bit higher, and that the Bank of Japan won't raise rates so that real rates will stay negative. And to be fair, the negative real rate in Japan has been a factor in the yen's weakness. But I think that gets to the point we were discussing at the beginning. The interest rate differential, nominal rate differential, has already shrunk. The Fed has cut. Bank of Japan has hiked. It hasn't supported the yen. We're still close to 160. If you look forward, clearly the market is pricing in at least one BOJ hike, and it would be unlikely that Kevin Warsh takes over the Fed and doesn't do at least one, if not 2 cuts. So the rate differential should go down, even if there's not a bigger adjustment in policy in the Bank of Japan. And so the final factor, and this is sort of gets very technical, is that the biggest winner in the Japanese economy from yen weakness has been the government of Japan, literally the government of Japan. The 2 biggest holdings of foreign bonds, unhedged, so benefit from yen weakness, are the foreign bonds held by the Ministry of Finance, not the Bank of Japan, on the balance sheet of the Ministry of Finance as part of Japan's reserves, which were bought at 80 or 100 and could be sold at 158, whatever. And then the second biggest is the 400 billion plus in bonds, 950 billion or so in foreign assets held by the government pension fund.
Mhm.
That there are enormous profits there. And the irony is that as the value has gone up, public investors don't tend to take profits. They don't tend to sell. Now, the GPIF does rebalance its portfolio, so there's some adjustments at the margin, but the Ministry of Finance doesn't. And so the natural seller, in a sense, would be the institutions that have taken profits and want to lock in those profits. And I think
Your advice is take the win.
my advice is at least
Stabilize
take
the
the win on the interest income of the Ministry of Finance's reserves. So if you
Yes.
sum up the bonds held by the Ministry of Finance, the total foreign assets of the GPIF, the hedged portfolio of a public bank, effectively, although maybe they want to privatize it, Postbank, you've got a foreign portfolio of well over $2.5 trillion, 50% of GDP. That gives you more than enough firepower to materially reduce this high level of gross debt that is causing so much concern. And what you specifically could do if you're creative, and like I think one thing we both agree on is that a lot of public sector should be a little bit more creative in managing the financial
Absolutely.
side of their balance sheet. Take the interest income, it's 30 billion-ish, probably closer to 40 billion a year now from the Ministry of Finance. Don't just reinvest it. Take it and buy back the long end of the JGB curve, retire bonds that are trading way below par, and you reduce your gross debt at essentially no cost. You're still got that interest income stream.
It's a massive return on investment.
A huge, and it deals,
You
George,
stabilize the yen, stabilize your imported inflation,
yeah.
And then you stabilize household purchasing power, and you give businesses a reason to engage in CapEx, and suddenly you've got a domestic demand story. I like it.
It takes away this sort of, there has been in my view, you will probably, I don't actually know your view on the technicals around the long end of the JGB curve. But I think, there has been a technical issue there because the legacy bonds have such a low coupon. They're incredibly volatile. And the natural buyers, the lifers, kind of were forced to stock up by regulatory shifts a couple years ago, and they aren't continuing to buy. And they seem to be a little shell-struck by the mark-to-market losses they've taken on this and by the volatility. So bringing in a new buyer or taking some of the legacy bonds that have lost their natural market out of the system feels like a technical debt management win to me.
Well, let's close on that note of relative optimism for Japan's prospects. I want to ask you one last question, which I ask everyone. What is the most commonly held belief in your world, however you define your world, that you think is just flat wrong?
Um,
You've got a lot of those.
Yeah, a lot of them. One is that
The challengers want to choose.
I mean, in a sense, it's everything we've discussed. One is that the world is deglobalizing, and then you can deglobalize when China is relying more on exports than ever before, has a bigger trade surplus than ever before. The second one is that China is not buying U.S. bonds. China's reserve managers aren't buying U.S. bonds. Chinese state banks are quite clearly buying U.S. bonds. It just doesn't show up in the data. And China is increasingly a source of dollar funding for a range of other bond purchases. I mean, I don't think you can understand the basis trade now, which is kind of, I guess, we can use those terms because there's a bond market specific podcast, without the repo funding that is coming from somewhere globally that is supporting one of the biggest and fastest growing pools of foreign held U.S. government debt. And then I guess the third myth that I think is prevalent is the notion that Japan is insolvent. Japan is the world's largest external creditor now as a share of GDP, way bigger than China. And Japan's government is actually a bigger external creditor as a share of Japan's GDP than China is. So I find those are like,
If Japan, Brad, if Japan is insolvent as a U.S. citizen, I wouldn't want to be looking in the mirror. Put it that way.
I mean, I could probably throw in a few other things like that. We can actually address our government debt issue entirely with tariffs. But
Well, I think so. I agree with that too. I mean, the asset side of our balance sheet is pretty rich. Brad, this has been a masterclass. Let's go to the basketball court again soon, while we can still walk. But thanks for coming on.
No, my
I
pleasure.
appreciate it.
Thanks for doing this.